Dale Miller. Treasurer Comas.
Present. Okay, and let the record show that we do have quorum for today's meeting. So having done that, before we get into the meeting agenda today, we will do public comment. Do we have any properly submitted public comment forms?
Yes, we have 3.
Okay, and just to reiterate the rules of public comment for the Investment Advisory Committee, all commenters are randomly selected from forms submitted prior to the meeting. They have to be submitted prior to meeting time, which is where we're pulling the forms from. We have up to 3 minutes per speaker, and we ask that you limit any commentary to items that are on the agenda or related to the agenda for the meeting itself. So having said that, who is our first public commenter?
Mark Ashed.
And if you could please state your name for the record when you start, that'd be great. Thank you.
Thank you very much, Mark Ashed. I wanted to just address council today. First, to acknowledge the difficulties in cash flow that have been cited as it relates to foreign investments, and we definitely share the concern and appreciate the fiscal responsibility and stewardship that the county is showing in kind of righting the ship before making any drastic decisions. Unfortunately, those decisions have been met with glee with some of the opponents who have been sort of criticizing our community and attacking our community for a while. And while the county financial situation is one we're particularly appreciative and sensitive to, it is worth noting that the Israeli bonds, as it relates to its credit ratings, have only been affected in one of the 3 major credit ratings services, and still holds investment quality bonds across the board. And so it's an issue that we're continuing to monitor. We hope that the cash reserves are able to be addressed in a quick manner, and definitely appreciate the county's financial stewardship, and look forward to ways in partnering in any way possible to continue to improve our county and improve the decisions being made at our county level. I just wanted to provide some additional context. The day that the decision was, or the announcement regarding the delay was announced, was the day that I happened to be in Israel. It was a particularly painful day, as a 9-month-old and a 4-year-old were returned in coffins as part of the ceasefire deal. So while we understand the financial considerations in making the decision, I just want to know that within the community there was a sensitivity at that particular moment and a pain. And it's something that we do a very serious job of trying to represent. And so look forward to continuing the financial outlook of our county continuing to improve, our cash flow continuing to improve, and with that, investments in Israel continuing once it is a financially prudent decision. Thank you.
Thomas Laction.
Hi, my name's Tom Lakshin. I'm the Executive Director of Israel Bonds for Ohio and Kentucky. We're a brokerage firm based in New York. We only work for the Finance Ministry of Israel. We only sell Israel bonds. And I'm registered to sell securities, and I'm the one who sold the first bonds here when Jim Rackauckas was treasurer back in 2006, and subsequently since then. I live in Cuyahoga County, I work in Cuyahoga County, pay taxes in Cuyahoga County. I would like to see the county get the full benefits of Israel bonds, which have been stability, diversification, and strong interest rates. And I'd like that to be on the 2% level of your portfolio, which is the maximum allowable amount under the Ohio Revised Code. And I especially like to see the $3 million that matured being reinvested. We have strong spreads to the benchmarks right now. I wanted to tell you that in 2023, the Ohio Treasurer purchased $100 million, most of which was after the war was started. In 2024, $75 million, and in 2025, so far, $45 million this year to date from the Ohio Treasurer, who's not had any issues, so to speak, with purchasing Israel bonds. And and holds $262 million worth of Israel bonds. Since the January 1st, we've had 18 government entities from around the United States purchase $335 million worth of Israel bonds. So Cuyahoga County is kind of in the minority rather than majority of our institutional investors of government entities. Like was mentioned, we're dollar denominated. Israel's an ally of the United States. They've never missed a payment. Israel's never defaulted in 73-year history. And as Mark said, they're still A-rated by 2 credit rating agencies. So far as I can see, they meet or exceed the criteria established in the Ohio Revised Code. So I believe Israel bonds are good for the citizens of Cuyahoga County and good for America. And my mission is just to help Israel, but also have a mutual help to your portfolio. So thank you for your time here to speak today.
Marlene Weinstein?
Good afternoon. My name is Marlene Weinstein. I'm a Cuyahoga County resident. At the January 24th, 2025 Cuyahoga County Investment Committee, a new sustainability policy was adopted. This policy states that social capital factors that may have an adverse impact on customers, local communities, and/or government, such as human rights, will be considered when making investment decisions. Yet, Ohio's anti-BDS law, Ohio Revised Code 976, quote, explicitly prohibits the divestment if the decision is motivated by participation in the BDS movement, even when framed as a human rights concern, end quote. This creates potential conflict between state law and the county's stated sustainability goals. During the January investment meeting, the Israel bonds were described as the riskiest item in the county's investment portfolio. This assessment is made in comparison to the county's substantial holdings of U.S. Treasury bills, which are widely recognized as among the safest. It is true that the ratings of Israel bonds have recently been downgraded by credit agencies, largely due to the ongoing conflict in the region. These downgrades come despite Israel's economic resilience and growth. Hopefully, God willing, the conflict will soon come to an end. Near the close of the meeting, County Council President Miller stated that questions about Israel bonds increased fiscal risk and issues around sustainability require careful scrutiny going forward. I was disappointed by the negative bias of this comment and hope that future discussions can adopt a more neutral and fact-based stance. A deeper understanding of Middle East history is essential for informed discussion and decisions. Broader context may reveal that what is often presented as a dominant pro-Palestinian narrative is, in fact, a selective and revisionist interpretation. It is also worth noting, as already stated, that the state of Ohio currently holds $262 million of Israel bonds, and as recently as February, reinvested an additional $35 million. Cuyahoga County should give serious consideration to aligning its investment approach with that of the state. Thank you.
That's all we have for public comment.
Okay, thank you all very much.
So,
Go ahead, Councilman.
before we move on, can I ask about a couple things?
Sure.
these are kind of mundane and technical in nature, but in regard to the agenda, in the interest of transparency, I would like to recommend a format similar to the agenda used for the county council meetings, which is that the agenda would state on the top, Investment Advisory Committee, and then it would state the date of the meeting, the location of the meeting, and the time of the meeting, rather than just saying Investment Advisory Committee and the date. So they just put that out there for consideration.
Thank you.
And the second thing is that I'm wondering whether we keep a list of email addresses of people who have requested to receive email notifications of the announcement for these meetings.
So that's a newly added piece of our policy. Yeah, go ahead, I'm sorry.
Yes, we have that.
Okay, good. Okay,
That is memorialized in the policy that we just
okay,
adopted,
good.
yeah.
Thank you. That's all I have. Thank you.
Thank you. And that is a well-taken suggestion, and we will add that for future agendas that we've got location and time also, so thank you. All right, next item on the agenda then is approval of our minutes from the January 24th meeting. Everyone has received those and should have had a meaningful opportunity to review prior to today's meeting, so we need a motion to approve said minutes.
Also move.
All right, thank you. A motion and a second.
And I can second.
Moved and seconded. All in favor, please signify by saying aye.
Aye.
Any abstentions or objections? That motion carries. Having said that.
Yeah. You know what, unless you want to keep going, Treasurer, if you do, why don't you keep the flow going? I'm grateful to be back, and thanks to my chief of staff for sitting in. I really came to really hear the investment discussion, so do you want to keep going?
Great.
All
happy to
right,
do it.
thanks.
Yeah, thank you. With permission from the chair, then we'll move forward. And the next item on the agenda is the fund and portfolio review, and my staff will start with that. And part of this, just for the good of the order, we've added a cash flow conversation because that's been an important topic recently, so we're going to touch on that here as well. So, team?
Thank you. Nico, next slide. Okay, so everyone should have a copy. The screens are hard to see because it's small print. But this is our portfolio. We have listed all of the top accounts are Star Ohio, KeyBank, PNC, US Banks. Those are banks that we use for daily operations. Star Ohio is where we flip our funds to every day when we don't have when we have enough allocation for all of our expenses, we flip everything else to Star Ohio on a daily basis. The investments I'm not going to talk about because our meter team is here to talk about those. And then we have opioid funds that Brandy isn't here, but Jed will just give a quick update about opioid, and that's about all. Currently, as of the quarter end, we had $1,064 million in our total investment market value. And we are within policy on all of our limits. If you want to flip to the next slide. So this is our cash flow projections. It's kind of hard to see the entire slide if you can move it up a little. But so because of our cash flow situation and our concerns, and we wanted to be more transparent with everybody that attends these meetings and with the public in general, we had, our investment team, finance and investment, had called together, and we've started to do this quarterly, all of the agency heads in the county. And this is an effort to keep a tighter watch on all of our expenses. We met 2 weeks ago with everyone. We listed all of the items that we had for our debt services, all the revenue we were aware of. And then at that time during the meeting, we went through and asked any of the agencies, were we missing anything? Lots of times there are budget amendments, there are different decisions made, whether it be by council, by agency, by projects that are coming, and they might be expedited or delayed, and we don't necessarily know down in finance and investment. So we decided to hold this meeting with everyone so that we could get a better handle on what we may be missing, so that we'll know better how to plan, and that way when the time comes, we won't be blindsided with, oh, we need $30 million to purchase this building, or this type of project needs this type of expense. So this is an effort we have. This is where we are. If you look down at the items in the red on anticipated uses of cash, there is an item down at the bottom. It's the jail note. That one is not included in our total because that is a note that is anticipated to be purchased by Key Bank, not paid for by Cuyahoga County. The other thing that I wanted to point out is in the bond maturities, our anticipated revenues, these are, while we're on a hold for reinvesting, these are our maturities through September 30th, which is where we anticipated being able to start reinvesting in other types of funds. So our projected balance is currently 57 million. We are trying to get that up to above 100 million, 125 million to have a safe threshold on not having to divest of any bond prior to its maturity date. Any questions?
Yeah, I just want to point out quickly, just to reiterate a point you made already. So the projected balance, 57,715,000 and change. In the spirit of NBA basketball playoffs, is the diff between what we expect to come in versus what we know we have to pay for. And that is through September 30th, right? So, and I appreciate the context you gave around trying to get a $100 million carrying kind of cash balance, just as a safety valve so that we don't have to sell securities prior to their maturity date. So that's what we're looking at now. We'll be doing another update to that in the summertime, just so everyone kind of understands what we've realized in terms of expected expenditures, what our expected revenues have actually looked like. There's a lot of fluctuation. Our next slide is known unknowns as well, so we'll get into that in just a moment, but I know
I
others
want
had
to say one
questions.
more thing. So everything is through September 30th except for the debt services. And the debt services, we did include the year end because we know them. So they're not unanticipated. Is there anything else I'm missing?
Well, let me provide a little clarity around that. Actually, it's all year-end except for the bonds. The reasoning for that is because the bond maturities, we're expecting to let those maturities continue to roll forward until September 30th. And that's why we're doing that double check. So at the end of September, we're expecting those bond maturities to add to our general fund as a source of funds. Beyond that, we're expecting to continue to reinvest the way we would like to be doing all along. But the other numbers are prorated for the annual, annual expectation. We can switch over to the next slide.
Just before you go, if I could ask, Chair, is the 42 million jail note, is that assumed to be, it's kind of lingering out there in that asterisk. Where is that coming from? Does that put our projected balance lower, or is this include?
If, for instance, Key decided we're not going to buy those bonds,
Yeah.
then we would have to sustain that out of the general fund.
I see.
So instead of having a $58 million surplus,
You're
we'd be
down
down to,
Right.
16.
Okay. Do we have any, well, I guess we can discuss anything further on that, but on the GMP, which I'm probably getting in the weeds here, but I think our goal was to have a guaranteed maximum price on jail by third quarter this calendar year. Is this assuming kind of a coincidental timing with the GMP, or is it separate and separate? I may be too deep on this.
It may be a little bit too deep, because I'm not familiar myself with the jail
Okay.
timing.
Yeah.
But that does align with our expectation, hey, we're doing a reset in September.
Okay.
At the end of September, at the end of Q3, we're gonna look at this from a bond perspective, from a
Yeah.
jail perspective. We'll have more information as time goes on.
Okay.
And we'll be better prepared to
Okay.
make decisions, but we
Eh,
wanted to,
Okay, gotcha.
right. So our next slide is gonna address a lot of the questions that were, oh, I'm sorry.
What is our EA?
Thank you. Real estate assessment fund. So that's auditors' funds that are for the purpose of doing real estate assessments. That's a required distribution. If certain amounts of it aren't spent, they have to be redistributed to the communities. So that's what that
And,
is.
That's an acronym.
and did I hear
okay.
you correctly saying that all the numbers on this list are projections through the year end except for the bond maturities? Is that what you said?
That's right.
Okay. And when's the last time that you did this calculation?
This was performed as of quarter end.
So, so this was performed as of quarter end.
Correct.
And so going back a quarter, this 57,715 projected balance, what was that number at the end of calendar year?
This is the first quarter we've done this.
Yeah, it's a new analysis. We can get that for you.
Okay.
Part of the thought process here is, and I think we touched on this in January, but we did have maturities. We had securities we had to sell prior to maturity to cover known obligations, which is the impetus for doing this analysis. So
So
it would have been a negative number in all likelihood.
So when we do this number, when we do this again
Yes.
at the end of this quarter, then we'll know whether it's going up or down.
Right.
That is correct. We'll have have more of a trend.
So we'll have an idea of both what the number is and what the trend is.
Correct.
Okay, thank you.
I just want to say before that, I appreciate you making the department by department requests for information. And I'm assuming, included in that was probably Public Works. Yeah, because they're going to be a big player in this draw schedule come third quarter this year. So
Mike came.
good, good. Yeah, thanks for doing that. Okay.
Next slide, you can talk.
I'll talk now. Yeah. Now, whenever we make projections like this, we always make assumptions. And we do that because we don't have a crystal ball. So we have to assume, and we try to identify those so that we can identify the causes of potential variance. So one of the big things overhanging our whole economy is the tariff impact. How is that going to impact people's purchases and thus our permissive sales and use taxes, other sales tax revenue? That's a big unknown. If you remember from the previous slide, a lot of that budget that we're expecting to come in is based on the permissive use taxes that we've received year to date. So if those numbers decline, that's going to severely impact the cash flow that we have, that we projected. So that's a big unknown. Of course, once the tariffs, if they're implemented, we'll be able to see some real world impacts if they do go through. Of course, the budget is determined, but the rate at which that budget is spent down can determine how much money we make in interest. The sooner that money is spent, the less time it spends in the market earning interest. So we're assuming that we're going to have an even spend down of the budget, and we're going to be close to that $24 million mark. If not, that's an unknown in our projection. Real estate tax collections, as those of you who own property know, we just had a reappraisal. So we're not sure if that's going to impact delinquency rates beyond what our historical numbers have been. So we're assuming a minimal impact, but again, that's some uncertainty that's injected in these projections. Payroll, we prorated it for the rest of the year based on first quarter numbers. But again, since we're doing a replacement reduction policy, we may not see that quite get to the same level. So we may see a positive variance on that item. As Eileen mentioned earlier, the REA spending may increase. So we have a $30 million plug-in right now, but our folks in FISC are saying that could change. We talked about the jail. We're assuming that note does get issued, it does get approved. We're assuming the budget stays where it is, and it's not going to impact the general fund at all as our current projection. So, and then last year we did have some debt services get expedited, where we paid them off earlier. We're assuming that doesn't happen again, but it's an assumption. So those are the known unknowns. Of course, there are always unknown unknowns, which, hey, by virtue of being unknown, I can't list them. Next slide, please.
And I just want to thank my team for putting that together and making sure that we're kind of illustrating for you the sorts of things we're watching in the market. I think that's valuable analysis for everyone to
Source
see
of
from us, so
uncertainty
thank you
and
for that.
why we want to have a liquid fund to accommodate uncertainty. And this is our opioid portfolio. Not too much has changed. We're still letting bonds mature because there's uncertainty as to, well, they have a plan in the works, but it's not yet approved. So we're not sure about the structure of this, this pool of cash going forward. Next slide. And this is our Ohio rates. You can see the spot rate at the end of the quarter. As of today, the overnight rate was 4.46%. So we're continuing to see that rate slowly decline. And that's, again, why we want to lock in those long-term yields as long as possible, as soon as possible, but not at the expense of not being able to cover current obligations. So again, there's an ongoing theme of conservation, pay our bills, and then invest long-term. At this point, we'll turn over to Meter, who will give us our anticipated market analysis.
Garrett, one more question before you get there. On the opioid schedule and the asset allocation, I presume you also got to talk with Public Safety and Brandy Carney?
Yes, yep.
My spirit of all these questions has to just do with this balance and liquidity and the sort of target goal of X for cash balance. From my last meeting with her, and perhaps we could do a deeper dive with her, we kind of marked the schedule of spend. I don't know if she went over that with you, but it's, again, good. I guess that answers my question. You saw that marked calendar because while it's not, quote, approved through all channels yet, it's at least there's a ballpark schedule for it. So,
Exactly.
yeah, and I mean, I think we all know that that's ultimately, unless there's a new source that comes in, that's a finite dwindling source, right? So, okay,
And we account for that as a separate investment
Yeah.
pool for purposes of these calculations
Okay.
too, so.
all right, thanks.
Okay, any further questions on the in-house portion? Seeing none, we'll turn it over to our friends from Meter. Thank you for being here, Jason. Good to see you.
Absolutely, glad to be here. Certainly, there has been no shortage of news the last couple of weeks. Yeah. Yeah. Lots of questions, lots of volatility. The good thing about all of this is that as people fled the equity markets, which we had, the 19% drawdown was the third fastest in history following the announcement of the tariffs. The good thing for you is what they were flying into is all of the stuff that you own, the safety side of things. So that has been good, but also had a big impact on rates. Today, we'll go ahead and walk through, give you a little overlook. The Figge model, this is one of the things that we take a look at, basically the big items that are affecting interest rates going forward. So the Fed funds, inflation, growth, employment, touch on all of those quickly. From the Fed side of things, their more recent talks, given all of the action that's been going on, they are still predicting just 2 rate cuts, so 50 basis points, 0.5% here in 2025. The markets are much more aggressive. They're pricing in right now about 1.1% in interest rates now. So we will see who ends up being correct. Certainly, the current administration is pushing very hard for cuts right now. From the inflation standpoint, though, still remains above the 2%, currently around 2.8%. That is really expected to remain pretty steady through the end of 2025. And we'll touch a little bit more on that. Growth through 2024 beat expectations, so remained very strong. Fourth quarter, we did see a slight downtick there, but still looking positive, not seeing a lot of economists who are coming out and saying, hey, we're in recession territory, so still looking pretty strong there. Employment still looks great at 4.2%. But as we were talking about on the yield side of things, as people flock to safety, we did see a pretty quick knee-jerk reaction, about 0.2% immediately off of the 2-year Treasury. It's down about 0.4% from its high earlier this year. So lots of movement with what's going on, but we'll dive in a little bit further here.
So I have a couple questions.
Sure.
First, on the inflation side, with all the tariffs being added to the costs of goods and services, what's the basis for not thinking that the inflation rate is going to go up from its current level?
Yep, so from the economist standpoint, when you get into the tariff side, which is a big unknown for a lot of this, and really when you go back historically, when you have the big tariff pushes, that tends to lead to trade talks. Once trade talks open up, those on average have been 147 days to get a remedy on the trade side. So you see a big hold as they're going through that. So even if you see an initial small increase on the tariff side, it's a long drawn out process before you're going to see a lot of that start to trickle through. So that's why for this year, they're looking at to remain pretty flat, steady. And next year is really where you get into a lot more of the unknown in terms of how all of those trade talks actually turn out and what that longer term impact is.
Second question, I know it comes somewhere right around this time of the month. have we gotten the preliminary GDP report on the first quarter yet?
Yep, they have the survey estimates out there, which right now for the first quarter, the estimate is coming at 1.2%. So that is down from 2.4% where we were during the fourth quarter of last year. So looking for those to, again, come in, and we'll touch on that here in a little even further detail on slide 5. Perfect. Any other questions before I go ahead and dive in? Yep. All right, on the Fed funds side of things, this is looking through really from the market expectations. Right now, the market not pricing in any action for the May meeting, but June is a pretty high probability right now that we will see a cut in June, looking at it for July, September, October of this year. And then December is more of a coin flip right now at this point. So again, with that, and like I said earlier, the Fed is saying that they think it'll be a 0.5% move, but the big thing, and really as we're looking at the investments, is right now there is big consensus that it is going down from here. It's just a matter of how much.
But that's a 0.5% aggregate, right? So the moves are still anticipated to be 0.25%.
Right now, they are
Probably, so two cuts effectively.
Exactly, yeah. If, for them to move off of that 0.25% right now, you're gonna have to have some sort of an event happen that would really push them to, oh shoot, we need to be aggressive and move quickly. So nothing on the horizon right now for that. On the inflation front, looking at both CPI at the top, so that's what we all see in the headlines of the newspapers, PCE being what the Fed looks at. As you can see, both of those measures are down dramatically from the peaks that we saw during COVID, but both have stubbornly stayed above that 2% target from the Fed. And that is, as we look in the future, the economists' predictions are for that to remain through the end of 2025. But to your point, the tariffs are really going to be a big driver of this, and how the ultimately goes through from what the reactions are. Do you see something that's more like the early 80s where there were a lot of tariffs that came in on the automobile front, which that ultimately led to a lot of the production of plants moving into the U.S. and ultimately a lot of job creation, which didn't lead to a lot of inflation. You have other times where you do see the price of goods begin to come up. So it really, a lot to see how this all shakes out. And you have certain countries who are coming to the table for talks, certain who aren't. And so this will be, it looks like it's shaping up to be much more of a sector by sector, different types of goods that could be affected by this into the future. On the growth, the GDP side of things, as we said, the fourth quarter did see that pullback where we had very strong numbers at 3%, 3.1%. The prior 2 quarters did see a pullback to 2.4%. If we went back to early part of the fourth quarter, all of the estimates for 2025 were north of 2%. So with the tariff talks, we have seen those come in pretty dramatically. Again, still not seeing anything in the negative territory, not seeing any, anyone forecasting a recession or from these survey estimates. But a big part for the pullback really goes down to the federal spending side of things, with the new administration signaling that they are looking to cut a lot of that federal spending. That does have a big impact on the GDP. So as those programs continue to come into place and we learn more about that, it remains to be seen exactly how big of an impact that has on GDP moving forward.
Just while we're on the GDP, what was the trigger event at Q4 21 to Q1 22?
So Q1 22 would have been.
I don't know. I'm just curious if you had, it was such a massive fluctuation.
Is that a COVID spike there?
That was a COVID?
I'm trying
Inflation
to,
spike.
that was, I think, where,
as a
you had that
result
big
of-
spike.
Yeah, coming out of COVID.
Kind of
Yeah.
COVID.
Inflation moving
Shot up.
Gotcha. Yeah, just, okay.
Yep. On the employment front, when we're looking at how economists view full employment, it's typically from 4.5% to 5.5% is viewed as full employment. We have been steadily below that, continue to be there today at 4.2%. And actually, if you look at the bottom chart here, this charts out the consecutive months that we've been below 4.5%. So currently at 41, that is the longest consecutive streak going back to World War II. So a long run that we've been on here. We had the COVID dip, and before that we were at 35. So who knows if we would have without COVID, would have been even longer. We'll never know. But certainly have been in a very strong spot from the employment standpoint. And this has been one of the big reasons why the Fed has really said, hey, with where employment's at, we can be patient. No need to really rush into the rate cuts moving forward. Looking a little closer to home here, whether you're looking at the state of Ohio, Cuyahoga County, both right on top of the national average, both right in that range for full employment. So really strong numbers throughout the local area here as well. And then taking a look at yields, while we have seen those come in, this is looking at both the 2-year and 5-year treasuries. We think we've seen our peak for this cycle, and fully anticipating they will continue lower. And while we've seen that happen recently with a lot of the news, still relative to the last 17 years, we're still at a very strong spot. I mean, as Jed was saying, really, once we get the cash flows where we want to see those, this is an opportunity, still a great spot to go in, locking in those rates longer term if we get the chance. So with that, any questions on the economic side of things before Mr. Click dives into the portfolio?
Okay, hearing none, we will transition over into a more specific look at the two portfolios themselves. Starting on slide 10, just as a review as we normally do, ending the first quarter, the total portfolio in the upper left corner ended at just over $800 million, $804 million to be exact, bringing the weighted average maturity, middle left of the page, at just over 2.4 years, remaining very consistent to where we have been more recently. Again, a big part of that without the reinvestments, there has not been significant opportunity to move the weighted average maturity of the portfolio. The good news through all of this is as many of these older securities that have been held for many years with lower yields, again, securities that were purchased 4 or 5 years ago, have rolled off, the overall yield of the portfolio has continued to increase. So back to the theme that we've had throughout multiple investment advisory committee meetings prior is extending the portfolio, as we were recommending and the county was aligned with doing, is certainly benefiting us. It's where we're seeing while rates are coming down otherwise within the market, the portfolio yield is continuing to increase, which we should continue to see even without the reinvestments. Now, it's not going to move up as fast without the opportunity to reinvest at the higher yields where we are today, but that trend is, again, expected to continue. That would put the estimated annual income over the next 12 months at just north of $25 million for the core portfolio itself. Shifting our view over to the right-hand side, the overall allocation of the portfolio remains quite consistent, with more than 80% of the overall portfolio allocated to U.S. government securities, with additional allocations at the larger end, 10% to corporate notes at this point, and 5% to municipal securities within the portfolio as well. The maturity distribution you see at the bottom, the next 0 to 1 year, which Eileen and Judd reviewed, we have 30% of the portfolio that is expected to mature between April 1st and March 31 of 2026. So we will be watching that closely with the internal team here, that once things move around from a cash flow standpoint to when we will be able to again begin deploying those funds into other securities to pick up that yield for as long as the yield holds in. Any questions on anything around the allocation of the portfolio?
Yes, I have a question.
Please.
My question is, what are we invested in on the items that are more than 5 years? And I thought that 5 years was the limit, so is this a problem?
So I'll answer the second one first. Is there an issue? No. What those longer dated securities are internal bonds that were acquired as part of, I believe it's a parking garage. So the parking garage that was done about 7, 8 years ago, I think, give or take, when those were positioned into the portfolio.
Okay.
Yeah, so those are not, great question, Those are not market-based securities. Those were special bonds that were created to fund the parking garage.
Yeah, and those are authorized by special vote of the IAC. It's required if we extend past the 5 years, that's statutorily allowable.
Yeah, so, right, yeah, no issue to compliance.
Okay, fine, good.
You guys, just on the allocations, it's a small amount, 5%, but does the, it's 5. Does the municipal securities concern you in any way or, no? Okay.
This time, no. We are watching that very closely.
Yeah.
Again, remember that from the standpoint of we're always beginning with extraordinarily high-grade municipal debt under law. So from that standpoint, we remain very, very comfortable with the holdings within the portfolio today. Transitioning on to the next slide, again, this is just the historical look at year-end periods for where the overall portfolio size, the weighted average maturity, and the weighted average yield. Again, comparing most recently the end of the year 2024, the overall portfolio invested portfolio, I should say, at $842 million with a commensurate yield of 2.92, the weighted average maturity of 2.52. So as we would expect, without reinvestments, the weighted average maturity of the portfolio is trending down with those maturities and the movement down closer to overall maturity. We ended the period Q1 at just over $804 million, as was shown on the prior slide, 242 and the 312. Just as a general comment here, with all of the discussion around spending and the portfolio size moving down, we did want to comment that the county here is not alone in this move. We work with many of the large counties around the state, and with the ARPA dollars moving out of the portfolios, money being spent down, this is a common trend that we see across all of our county portfolio client or county client portfolios. So you're not alone in this regard, and something that was certainly anticipated. It was just a matter of timing, and as things boil down to the ultimate spending of these funds.
I appreciate that context very much, thank you.
So, okay.
On the next slide, again, our compliance report as it pertains to the core portfolio itself, you will see every one of the holdings ended the period within the normal compliance standards. So everything good on the home front there.
Which of these categories is Star Ohio considered to fall in?
So within the core portfolio itself, there are no investments to Star Ohio. Remember, this portion of the report is only the invested portions and the sweep vehicles that are held within the custodial accounts for the core investment fund.
So things that are essentially cash are not included in this part of the,
That is correct, not in this $800 million core portfolio.
okay, and the U.S. government agencies, is that things like Ginnie Mae and Fannie Mae and stuff like that?
Correct.
And I see that you have a diversified split between that and the treasury bills with a little more on the government agency side. What are the advantages and disadvantages of investing in those government agencies as opposed to the treasury bills?
Great question. So a couple of fronts here, and really the area where we focused in most in terms of purchasing is we are always evaluating when we are investing the relative yield spread that the U.S. government agencies would provide relative to U.S. treasuries. While in normal course, had we been reinvesting along the most recent period where we've held off on reinvestments, those reinvestments would have moved back into U.S. Treasury securities. So we would see that being a bit more normalized in this case. Had the over the last quarter, the $40 million that matured, had that been reinvested, we would have seen the Treasury side move up, and it would have been a little closer to a 50-50 mix overall. So we've gotten to this point where the government agencies slightly outweigh the Treasuries, more along reasons of timing and not reinvesting.
And also, the spread really comes back to a lot of what the agencies need.
Correct.
So when they don't have nearly as much funding needs, their rates will come down right in line with US Treasuries. So if there's no additional value, then we take the US Treasury. So it really, and we've seen a lot of volatility from the agency side in terms of needs from funding. So that's why you'll see us go between the two.
And what's the current spread?
Currently, they have been in the, I believe, 4 to 5 basis points. So really, really close right now. So not picking up a whole lot.
Yeah, which, reflects the earlier comment of when reinvesting into current markets, we would be favoring the treasuries.
And if you have a time that's very favorable to government agencies, how large would that spread be?
And there have been times, and depending on, really this gets into the type of security you're buying as well, if you want to get into callables or fixed rate securities, but you will see that spread move out to, for like types, really in that 15 is top that you'll see.
15, okay.
Yeah, 15.15%.
Yep.
So,
Yeah.
so you're making decisions based on 1/10 of a percentage point.
Yep, exactly. Yeah, which at the end of the day, with the size portfolio of the county, certainly from.
It's real money.
it
Yeah,
ends up
it's real
being-
money.
Exactly,
ends up being-
exactly. It is, you look at that number and you're like, oh, that's a small number, does it? And then you run the math and you're like, holy cow, this is real interesting.
And just because you brought it up, Star Ohio, it's never a great time to be trying to aggregate cash, but all else being equal, Star Ohio is returning relatively higher than it has for a long time. And the fact that there are not a lot of anticipated federal funds cuts, that gives us a little bit of space and cushion to make that change and build that portfolio for cash up. So just wanted to point that other side of the equation out.
Yeah, great point, which is a great segue into the next slide. Looking at our quarterly comparison as we do from quarter to quarter. As mentioned earlier, the overall portfolio ended the quarter with a weighted average yield of 3.12%. We put two comparison numbers in here for everyone's benefit. The first being the 0 to 5 year US Treasury Index, which is going to be the more representative example compared to the portfolio itself, with that maturities that are going to range from 0 to 5 years within the core portfolio itself. That index ended the quarter at 2.72. So the portfolio itself doing much better relative to the longer dated index overall. To Brad's comments, Star Ohio still remaining at a very high comparative overnight yield with where Fed funds rates have held in at the end of the quarter, as Judd said earlier, has come down a little bit, ended at 4.48% overnight yield. So going back to the comments overall of what the Fed is saying, and then you also have what the market is pricing in, which we have always talked historically of there can be a divergence here, and we're seeing one yet again. So the Fed's saying one thing and the market's saying, well, we don't quite believe you, and indicating that we may see something different. If the Fed ends up, or what the Fed is saying today ends up being correct, we would expect that Star Ohio will remain in at the higher yield even longer. Should things move more quickly and the Fed would move down faster, we would see the opposite. The portfolio, the core portfolio yield is going to continue growing toward Star Ohio's yield as Star Ohio's yield is trending down. Any further questions about the core portfolio before I finish up on the opioid settlement portfolio?
Would you describe what we currently have as an inverted yield curve because the short term is higher than the long term?
Correct. Now, more recently, the inversion has improved compared to where we have been over the last year plus, but still an inversion. It has flattened out tremendously, but still an inversion to the short end.
Yeah, especially when we're looking at the permissible investments for the county.
Correct.
You're still pretty inverted for overnight versus out to 5, even 7 years. But once you get to the 10, 20, 30-year rates, then some of that inversion has gone away. And some of the, so we have a big dip.
Mm-hmm. Okay.
Right, so moving into the opioid settlement portfolio, I'll move through quickly for the benefit of the committee. The portfolio stood at just over 63 million in the aggregate at the end of the first quarter. The weighted average maturity of 2.37 years. The weighted average yield of the fund a little higher than the core portfolio, totally dependent on timing of when these funds were ultimately invested. That's the key driver here. At 3.47, which would show for anticipated 12-month annual or income of just over $2 million. The allocation here, you'll see, as I was speaking to earlier, a little higher on U.S. Treasuries, but overall, nearly 100% of the opioid settlement fund is allocated to U.S. government securities between the Treasury and agency securities, with a small allocation to commercial paper. And then the maturity distribution, see here, a bit more normalized, but very similar to the core. We have 26% of this portfolio that will mature over the next 12-month period. And we have a number of really great securities locked into the portfolio, which will continue to hold that yield in over time. The next slide for compliance, again, all measures of the opioid settlement fund being within the normal compliance standards as well. I'll open up to any questions about the opioid settlement fund. Hearing none? Oh, go ahead.
Just an off-the-wall suggestion, and it's out of your scope. It's in our bailiwick. But if we have 60 million and it's making $2 million a year, well, we could turn it into an endowment fund and not spend it down and have $2 million a year. It's going to change from year to year depending on market conditions, but we could have money to spend on opiate prevention in perpetuity.
Just through the chair, Council President, I think there's something to take up. Our treasurer, our spend allowance off of a quote-unquote endowment, if there is such a thing in the public sector that we do, is 5%, or is it whatever?
That's right. I'd have to look at that. I don't have that.
Yeah, so you can net $100,000 a year. So that's probably for us to take up.
Yeah,
Thanks.
that's a little beyond the scope of our conversation, but it's a point well noted. So thank you for sharing that.
Thank you, Council President.
And then the only other thing I would mention, just because we kind of got into a little bit of the question of what are the securities that are here or there, we do have a monthly report that we submit to the Treasury of State's office that spells out all of our holdings, security by security, and that's published on our website as well. So if anybody wants to find that, it's publicly available. So. All right, moving on then, just a couple of quick updates before we adjourn. I am going to keep us under an hour. Link deposits, we continue to have conversations with the Housing and Community Development Department as well as the Community Development Department on how we can utilize the link deposit tool to do more good in our community. We have had a couple of positive conversations now with our banking partners in the area. We had a call a couple of weeks ago that I think we had 30 some odd banks represented on, so we continue to have those conversations. I have asked for them to respond by Wednesday of next week with their interest in participating in either Heritage Home Help or what we're creating for small business, which is a to-be-branded product. So whether it's one, none, or some combination of those, we should have a better sense of by the middle of next week in some direction. So something that's very I think timely, especially as we talk about affordable housing and how we create opportunities for people in our community. Having come from the Land Bank Conference today, I know that conversation is one that's also happening all over the state and in the context of using these tools to do those things. So we continue to work on that. And then other business, just for the note of the good of the order, you see Investment Advisory Services RFP here. We do have an RFP in the field. It is not speaking to the quality of our representation or the work done by these fine gentlemen. It's just been some time since we had a look at the market to see what was out there, so we're engaging in that process. We have a response deadline in the middle of May, and then we'll be following that through as we move forward on that with a recommendation to council at that point.
So when does our current contract with our fine folks over here end?
Do you have that off the top of your head? So I'm sure you do. Thank you, 12/31. I know it was
What
soon.
did you say? this year?
Yeah.
Okay, fine, okay.
Yeah, there you go. So plenty of time to get that done. Yeah, thank you. Try to be, yeah. Anything else for the good of the order? Hearing none, can we have a motion to adjourn, please?
So moved.
Okay.
And second.
Moved and seconded, and without objection, we are adjourned at 3:27. So thank you all very much, and we'll see you next time.